Hey everybody, Lawrence from financialthink.com. Today I am in Mayfair in London with the Property Crowd. We have Rohin Modasia at Property Crowd. We have some questions here. Thank you, Rohin, for sitting down and telling us about your company. So, first question for you is, when was Property Crowd established?
So, Lawrence, good to have you here. Property Crowd was established by Scott Trapnell in the middle of 2014, single-handedly, I should add, actually. So he launched it and was running it single-handedly back then, and he successfully completed a 1 million real estate equity deal, which was crowdfunded. And at the time, that was the largest real estate deal crowdfunded in the UK. We came across Property Crowd and saw the opportunity to scale the brand and the platform using our independent marketplace model. So we then we acquired Global Alternatives, which is our company, acquired Property Crowd, and Scott joined our team. We relaunched the platform after we fully rebuilt it. We relaunched it in line with our securities exchange framework as a business model in 2017.
Now you have a very unique offering in the peer-to-peer lending marketplace. So for somebody that's not familiar with what Property Crowd does, tell me about the product, the investment product that Property Crowd offers.
Sure. So the investments that are available to investors on our platform are short-term senior and mezzanine loans secured on property. And these investment opportunities are made available in the form of standardized bonds on our platform. So these are financial securities instruments. It's not a peer-to-peer lending platform. Our platform, Property Crowd, is designed to be an independent marketplace, right? So independent meaning that as a platform, as a business, we are entirely independent of the origination and the management of these loans. We have a panel of specialist lenders who are in the market writing, bridging and development finance loans to borrowers. That's what they do, that's their business. And such lenders join our panel, provided we approve them to join our panel. We have quite a rigorous approval process in where we look at the track record, we look at their qualifications as in terms of the officers of the company, and most importantly, we look at the underwriting criteria and underwriting standards that they implement in their origination process. So, and we've actually, many lenders we've engaged with have failed that approval process. So we have independent origination from our panel lenders, who are essentially sponsoring lenders for every single loan. So when an investor comes to our platform to invest in a specific loan opportunity, that loan, in arriving at the platform at all, has gone through a process where it's being originated, assessed and underwritten by a specialist lender in the market. That lender then comes to us with loan opportunities to access funding. We will provide up to 75% of the funding for any one loan, which means that the sponsoring lender is required to fund at least 25% of that loan, strictly on a pari passu basis. Right? That's real skin in the game. Very, very important. So when the investor sees the loan opportunities listed on our platform, it's been through really substantial layers of due diligence, analysis and de-risking by the time it arrives there. So we turn away approximately half of the loans that are presented to us by our panel lenders. We turn away, and the ones that do proceed, the lenders have to have skin in the game, and then there are ongoing reporting requirements. Those sponsoring lenders are responsible for managing and servicing that loan right through to full repayment.
Okay, and for somebody that might not know the difference between, you said you're not technically peer-to-peer, you operate more like a bond. Just give me a real quick overview of what the difference is.
So peer-to-peer means two things. Peer-to-peer specifically is a regulatory regime and permission under the FCA in the UK, and also in other regulated jurisdictions. We don't operate as a peer-to-peer in that respect. We are a securities business, and our platform is a securities-based platform, right? So for each deal that's available on Property Crowd, it is a bond security. So that deal has been securitized and is placed as a bond instrument. The other thing that peer-to-peer means is the specific business model, right? Which ties into the regulatory regime or the requirements from the regulator. With peer-to-peer, there is a direct, even if you have the platform operator as agent, if you like, in the middle, there is a direct contract between the borrower and the lender, or the lenders, of which there are many in any one loan. And that comes with many implications, but that's a critically different format and outcome when the deal is done to a bond securitization and placement to investors who are now holding a portfolio of financial securities.
Your bonds tend to be on the shorter term. What are the advantages of having short-term bond terms than the longer terms that, you know, some of the peer-to-peer loans are obviously up to 5 years? Is there an advantage to a shorter-term bond?
Yeah, sure. It's quite remarkable that, you know, these distortions still exist today, but in short-term real estate secured or property secured lending, the returns that are available on a risk-adjusted basis are profoundly more attractive than any other asset class. So in the short end of that spectrum, where investors have the ability to invest on a 6-month horizon, even an 18-month or 24-month horizon, and they're able to earn such a strong return, you know, high single digits for a fairly conservative senior debt position, they can earn the kind of returns without having to tie up their capital for extended periods, which then also gives them the much greater ability to diversify their investments because of the shorter liquidity cycle.
Mm-hmm. That's a big advantage, obviously.
That's a clear advantage.
Yes.
Yeah.
Okay. Let's talk a little bit about Brexit. There's a lot of uncertainty at the moment what's going to happen with that, whether it'll be a soft Brexit or a hard one. A lot of people email me and ask me, where do I think the property market is going to go in the next year, 2019? What are your thoughts on what do you see happening to the UK property market in general?
Lawrence, to be honest with you, without having a crystal ball at my disposal, your guess is as good as mine.
Mm-hmm.
So
you just have you don't know.
I can't predict the future.
Can't predict the future. Okay.
We're not in the business of calling the markets.
Fair enough. What do you think? How is Property Crowd positioned if there are some fallout from the Brexit side? How are you positioned to weather that storm?
Sure, that's an interesting question. Actually, we in the last few months we've been considering various scenarios that could come into play with what's happening in the UK and the impact that would have with respect to, you know, property or secured lending on property in the development and the bridging finance space. We look at it from two perspectives, not just with respect to ensuring that, you know, if there's a fallout in the market, how does it disturb or affect our platform and our business? Actually, more importantly and more interestingly from our perspective, we look at it in the light of what opportunities may present themselves in those different scenarios, and how can we ensure that we are prepared to capitalize on those opportunities.
Yes.
And make that opportunity available to investors via our platform, right? So that's where, you know, a platform type model where investors have direct access to an investment opportunity or an asset class where previously they didn't have access to it. That's where it becomes really interesting, is in those situations where, if you go back to, let's say, the global financial crisis, for example, had property-based lending, whether it's in the form of peer-to-peer or whether it's in the form of securities business, being available at that time, it could have been really quite interesting for investors to get access to opportunities now on, you know, where the risk had really normalized. Mm-hmm. But then also on the other side, for the property investors and developers in the market, at that point, there was no access to capital, right? So had this more open format been in existence at that time, perhaps things would have played out differently.
Mm-hmm. Yeah, and it's a good time to be a buyer when everybody else is selling.
Precisely.
Is Property Crowd a profitable company at this point? And if not, when do you expect to be?
So Property Crowd as a platform is profitable, and in fact is actually ready to scale. So we're quite excited about where Property Crowd sits today in terms of its ability to grow, both with respect to deal origination listings and scaling on the distribution side to investors. We have several key aspects of our roadmap now about to come into play in the immediate future and the medium term, which you should see in the market come into realization that Property Crowd could quite quickly become one of the leading platforms in the UK, because until now it's been fairly unknown, quite small. We haven't really marketed it very much, and until recently Property Crowd was actually serving as a proof of concept for our business.
So Property Crowd has been sort of like this test platform for you to see if this is a sustainable product offering. When you say proof of concept, is that what you mean by that?
Yeah, in two respects. One, with respect to Property Crowd itself, right? Is this a horse that we want to back for the long term? Kind of retail crowdfunding. Secondly, and actually of greater interest to us as a proof of concept for what we're doing as a business, is something that hasn't been done before. Under Global Alternatives, we're establishing a cross-border trading exchange for institutional real estate investments, and that includes primary placements. Right? Primary placements meaning where deals are listed for raising of capital purposes, and those deals are made available to investors. So for us, Property Crowd was actually a very quick and easy way to establish the proof of concept for that wider institutional infrastructure that we are going to be deploying in the market. And what we kind of realized probably around the middle of last year is when we started seeing what's happening to other platforms in the market, in particular in the peer-to-peer space, the pitfalls there, the mistakes they've made, but also the inherent fundamental flaws within those regimes and business models. Property Crowd is in a position, actually, because it's such a strong platform, such a strong proposition, that it could become a leading platform in the UK if we stand behind it and support it and grow it, which is what we've decided to do.
A lot of companies in the peer-to-peer space obviously are venture capitalist backed. Do you have adequate funding to really push this growth of scale? Are you well funded as a company?
We're not VC backed. That's not to say that we might not have some VC funding further down the road. We don't particularly target VCs. Mm-hmm. We tend to go more for strategic investors from the world of real estate and the world of financial services. We undertake, as with many young companies, we undertake fundraisers, and actually you find as a young company you're kind of always in fundraising mode. That's a reality for the first few years. So we are well funded, and we'll continue to raise capital as we need to until we get to the point where we don't need to, which actually should be within the next 18 months.
I talk to a lot of financial advisors about the alt-fi sector in general, and they're still very much sort of closed off to it as being a consumer, a place that consumers can invest their money, due to a lot of, I think, of a lack of understanding. What would you tell somebody that's on the fence about using alternative finance as a place to invest their money to get a better return than what's out there right now?
We haven't engaged very much with the kind of IFA sector in the UK. What we do know is, firstly, anything which is, IFAs tend to be comfortable offering kind of packaged fund type investments to the clients, which are, which have a strong, big institutional brand name, like a Fidelity, for example. Mm-hmm. It's quite easy for them to kind of propose that to their client base. Whereas single name or single asset investment is something they're not really familiar with. It's akin to stock selection, which IFAs don't typically do. That's more the realm of a private bank relationship manager, or a wealth management company or multifamily office. With respect to alternative finance, otherwise, it's a very mixed bag, right? There are very compatible. There's a lot of compatible investments within alternative finance which financial advisors could make available, and I think we'll see that happen over time. These kind of things don't happen overnight. Mm-hmm. With peer-to-peer, hard to see that happening actually at any time. Peer-to-peer was designed for direct access from the consumer. Peer-to-peer has its in our opinion, fundamental flaws, which I think mean that, especially with respect to property-based peer-to-peer lending platforms, in our opinion, they probably won't exist in its current form for much longer. There are inherent risks, which are hidden risks in that model, which both investors and financial advisors probably are unaware of for the most part. But some of the risks are actually beginning to manifest in reality, so they're kind of coming to the surface, which is why we expect that either the regime itself will change under the regulator, or it could even get pulled, right? With our platform, it's a securities-based model, so it's fundamentally different. However, for financial advisors, that the aspect of single name investing or single asset investing, it's not what they do. So with Property Crowd, it could be that a diversified fund of deals with different risk parameters, etc. That's something we could consider in the future. That's something that would be much more compatible and within their comfort zone of what they can offer to their investors.
Talk to me a little bit about investors that come through Property Crowd, invest their money. We've had a situation where people have been part of legal action, and some people are a little afraid, of investing in newer companies, so they want to know how they're going to be protected against any sort of legal action that was directed towards not only the company that they're investing through, but them personally. Is that something that could possibly happen through Property Crowd, or are they protected in some kind of way against that from happening?
Yeah, that's completely, those kind of scenarios actually it's astounding that they can actually happen in this day and age, but we've seen it in the market too. No, frankly, it's impossible for those kind of scenarios to play out with our platform. And it goes back to that most important difference between Property Crowd and its competitors, which is all of the deals which are made available for investment. They are independent, professionally and independently originated by established lenders in the marketplace, who are originating and managing those. These are the guys who are dealing with the borrowers. So there is a professional interface between Property Crowd's investors through their bond structure and the ultimate borrower. Mm-hmm. The borrower doesn't see the Property Crowd investors. The Property Crowd's investors don't see the borrower, and there is no contractual relationship directly between the two. So it's impossible that can happen.
That's a good thing. One of the things I think that you were discussing some of the flaws in peer-to-peer lending. Maybe one of those things is the valuations. You've got these LTVs that are set at a certain rate advertised to lenders, and then a property may default, goes through the default process, and the recoveries on that property are far less than the valuation amounts. What is it that Property Crowd does to make sure that the valuations on the developments are actually accurate?
Sure. It comes back to exactly the same attributes that I just mentioned, which is there is professional and independent origination, and those specialist lenders who are sponsoring lenders on our platform, who are originating these loans, are investing their own funds in that deal on a pari passu basis with investors via our platform. So you have prudence, you have competence, and you have long-term commercial common sense in everything that they do, right? So that alignment of interests and the alignment of the professional competence, which translates through the deal all the way to the investors on our platform.
Rohin, since you are offering bonds, not direct peer-to-peer loans, can you tell me how that bond is securitized, what security there is behind the bond to cover investors' funds?
Sure. So with the way that the deals are structured, you have a specialist lender or the principal lender who is lending the money to the borrower. That loan that they're extending to the borrower, single loan, right? It is secured by, as normal, a position on the title. So if it's a senior loan, it's first charge on the property title. If it's a mezzanine, it's second charge on the property title. And there'll be an appropriate intercreditor agreement in place between the senior and the mezzanine. Our bond investors are subscribing for a bond which is issued by an SPV, which is a bond issuer. That SPV is independently governed by the appropriate trustees, not by us. And that bond issuer has a position directly on the property title as a subcharge or as a restriction on the title, unless the lender has an independent security trustee who is actually acting on behalf of all lenders of record. Right? So that's the ideal structure, is where there is a legitimate security trustee as an independent party who holds the security on behalf of all of the lenders within that syndication structure, including ultimately our bondholders. So whilst it's not there directly on that bond instrument carries right through to that position on the security held on the title of the property itself.
Okay, Rohin, let's talk about worst case scenario, the property crowd were to fail and cease trading. Explain to me how investor funds would be protected and what the wind down process would be, and also the data backups of people's portfolios.
Happy to answer that. Actually, I'm glad you asked that question, because again, it's one of the most important aspects of how we've designed our business model and how that translates through the Property Crowd platform. The situation would be quite similar to if you were to take the London Stock Exchange, and let's say you had investments in companies who are listed on the exchange. If the exchange failed, your investments remain intact because you are holding securities which still exist, and your cash, which is held at regulated brokers, is intact in segregated client money accounts. In the same fashion with Property Crowd is an independent marketplace, a securities marketplace. The cash and securities that investors hold are not held by us or on the Property Crowd platform, they are held with a regulated custodian. So if Property Crowd as a platform ceased to exist, those cash and securities, the investors' assets, would be wholly undisturbed. The second point, again very important, is that in the absence of Property Crowd, if investors have positions in live loans through these bond holdings, each deal, each loan that they have invested in is actually originated and managed and serviced by an established lender in the market. That lender is still there. So going through the servicing and the repayment process is still undertaken by a competent party. It doesn't change. In fact, that process would remain also undisturbed. So from an investor's perspective, essentially what that would mean is that they've lost their dashboard, and that's really it.
Mm-hmm. What would happen if one of the lenders actually went out of business?
That's interesting. So if a lender went out of business, then it would rely for the deals which have been listed or sponsored and listed by that lender. It would fall on what are their succession procedures. Who do they have lined up to essentially take over that loan book? And that will vary by lender.
Okay. Do they have to have that in place? Because I would imagine, are those lenders regulated to have such a custodian set up the same way that you would have, or not?
It's in a very different manner. They're not regulated. Bridging and development finance lenders are not regulated under the FCA.
Sure.
There are certain requirements that they have as best practices in the market, very different to a securities business. And again, which is why you can expect a variance across different lenders. If they were to fail, what would be the following steps of kind of taking over that loan book, administering and managing that loan book? What does that mean?
Anything else that you wanted to tell the watchers out here in financial thing world about Property Crowd, since they may not know so much about you? Hopefully they know a little bit more now.
Have a good look at Property Crowd. It's a very high quality value proposition for investors. We think it's a highest quality offering in the market. So have a good look and consider investing on our platform. We're going to have a lot more deal flow this year, and a lot more interesting and diversity. So today we've offered already real estate loans as investment opportunities across lenders, right, who are originating, across sectors, across strategies, and soon we'll be offering across geographies.
Okay, well, thank you, Rohin. Thanks for your time. Check out Property Crowd, and we'll catch up with you next time in a few months, see how you're doing.
Great, sounds good.
Okay, appreciate it.
Thanks, Lawrence.